Welcome to the Innate in the Room webinar. It's great to have everyone here. First and foremost, my name is Stephen Backhouse from Innate, and today I'm chatting to John Duncan from Old Mutual Investment Group. How are you, John?
Well, thanks, Stephen. Good morning to everyone who's tuned in.
Yeah, no, good. Before we kick off, John, and everyone, just a couple of house rules. So just for the audience, before we start, I've had some sound issues. So you'll see that I might say it looks like I'm on mute on the screen. That's because my computer mic isn't working. So I'm actually on my phone and on my laptop as a workaround. But I'm glad we got it working this morning. But we had some nervous moments. Quickly before we get into the chat, we're just going to go through the usual house rules. So today's theme is very much about responsible investing. These webinars are an hour long. So we start 9:30. We'll be done by 10:30. The format we use is, myself and John will have a conversation. Please post questions. We want to make these as interactive as possible. So John and I will chat for about 20-25 minutes or so. Post questions on the Q&A tab. And my colleague Arifa actually manages those for me, and then we'll then get into the questions at about 10 o'clock or so, and we'll chat around those questions. They may take us all the way to the end. If not, then John and I'll carry on with our discussion. As I said, we'll end at 10:30 sharp. You do get a CPD point for attending today. So, and if you attend the entire session, then it's automatic. If for whatever reason you got to fall off after half an hour or whatever, then you do need to do a short assessment to get your CPD point. So just FYI. Otherwise, I think that's it. Just checking my notes here. I think that's it in terms of the house rules. So welcome, John. John is head of responsible investing at Old Mutual Investment Group. I think the theme of today's webinar we put as a kind of is ESG investing. Why is it more than just a tick the box? But again, what I find interesting is actually you call yourself head of responsible investing. It's a much friendlier, nicer term than ESG, John.
It's easier to understand.
Yeah, it's and one thing I want to maybe from the audience perspective, how did you get into responsible investing?
Yeah, look, I'm a dyed in the world hippie, if I'll be honest with you. I studied engineering and I did a master's degree in environmental science, and that opportunity to convert into a master's degree sort of was presented in '94. It was the first time at UCT and sort of around South Africa where the field of environmental science and studies was made a formalized degree, and it kind of coincided with I guess a shift in the national legislation that sort of suddenly, the government in '94 recognized that there's a whole range of really important sort of environmental resources that the country has, and in order to guide our development and growth, we should be sort of conscious of those issues. So I guess I find my way in to the field of environmental science, and I think it's important to start there through a formal sort of education space. But I then spent a good 15 years working as an environmental sustainability consultant, working all the way across Africa, Eastern Europe, the States, working on, I guess, a lot of permitting work, but also a lot of corporate risk work, as well across many different sectors. And the back end of that journey, I ended up working in two areas of specialization. One was due diligence for inbound project finance deals into Africa and private equity due diligence. So, so for an example would be like I worked on the there was a transaction where Xstrata wanted to buy the Rusal aluminium mining assets in Russia for, a good couple of billion. And part of the work at the time was to due diligence the asset and see what's the price of the environmental risk and cleanup cost that you're buying when you get this asset, bring that into the deal room. So I had a lot of experience from a financial perspective. And then about a decade ago, right when South Africa was redrafting Reg 28, there was a redraft of Reg 28 when they reallocated the asset class allocation limits. In that process, there was a discussion around should we consider sustainability assets as a new asset class? How should Reg 28 confront this? And I was contracted by a bunch of financial services sector clients to be a voice in the room on that process. And at the time, Mutual, as a large, multi-decadal, liability holder, thought, hey, listen, this is an important topic. We need someone in the house. So, that's kind of a précis of how I ended up here. But it's been an interesting journey.
Because I think it's importantly is that, as you say, kind of responsible investing is now, or ESG has now been around for a while.
Yeah.
And it's always been a kind of a topic, but it's always often kind of on the side, or you go to a conference and there's a session on it, but not necessarily everyone attends that session. Maybe from a layman's point of view, can you explain kind of what responsible investing or ESG actually is? And then once we've done that, we can really get into kind of the conversation of kind of why that's important for the advisors and then and obviously their clients.
Yeah, so I think the easy summary here is that sustainability as a field is a field of study that's kind of a field of awareness that I guess has grown over the last 3 decades. About 15 odd years ago, I think 20 of the world's biggest pension funds got together and they said, hang on a second, we are investing money with long multi-decade horizons. It doesn't make sense to invest our assets today in a way that erodes the quality of the systems on which we're going to rely on in the future. So it makes sense to consider these long-term systemic risk issues. And so the point being, responsible investment is a style of investments, which I think is cross-cutting across every single investment practice around the world, that simply says, when you invest, you should consider risks that exist outside of just the market system. And so it's a recognition that the market is a subset of society, and society is a subset of the biophysical environment. And if the biophysical environment fails, societies fail. We've experienced that in Cape Town. What's the risk of drought? We know what that means societally, What's the biophysical risk of runaway virus? We know what that means. It's a biophysical system risk. We also know what's the social, what's the risk of income inequality, or mass scale corruption in a society. What's the effect of that on the market? And so responsible investment, to answer your question, in simple terms, it's a voluntary commitment to consider a very broad range of long-term risks when you analyze and build portfolios. And the ask is to do that with environmental and social issues in mind. Now, I'll just say 2 quick things. The origin of this is a European thing, and it's based on a set of principles. So it's been historically, I think, driven out of Europe by institutional investors around this idea that sustainability is important, and as fiduciaries, we should respond in this way. And I think that's an important thing because it evidences this idea that ethics and beliefs and how we decide things matters when it comes to money. And I think advisors will understand that.
Yeah.
The other part of it, and I think it's been a bit slower to come, but the flywheel's really starting to turn now, is that the economic reality of businesses that make their revenue from the production of a good or a service that's part of a sustainable economy, these are the winners in the future. So on the one side, you've got responsible investing as a voluntary set of sort of aspirational commitments that institutional investors have made, and it's wrapped up in the UNPRI and CRISA and Reg 28, etc. My goodness, it's the one thing I didn't do. Turn my phone off. Apologies. And so, alongside of that is this idea that actually there's a real business case to be had here. And what's happening at the moment is that this has shifted from a voluntary aspirational set of fiduciary commitments that people have thought about doing because it makes you feel good, so the periphery argument, to actually, we are at a point in the world's history where the economy is flowing towards a much deeper recognition of the systemic shift around climate, society, and the like. And that, the winners and the losers will be defined by looking at the world through this lens. And so now suddenly the race is on. There's ESG data, there's product development, there's fund flows, and that's where the transition has happened. It's now become a retail story.
So, I think, it's interesting is it always like bring it back slightly. Earlier you mentioned Nike. So now, and you mentioned that kind of, 20 years ago, people were going, hang on, where are my running shoes being made? Are they being made in sweatshops in China? Now, I don't know what Nike has done since then, but I imagine they've gone, hang on a second, if we want to carry on being a big player in the running shoe and the shoe market, we better sort this out. Because we are now 20 years later, Nike's still a really good big brand and big producer of shoes and clothes.
Yeah, I think certainly that's our experience. And I've witnessed this over the last 20 years in this field. The sustainability spotlight is kind of moving across different consumer product categories. And everyone will sort of know the sort of Nike Reebok story of 20 years ago. But the same is true of cell phones and, to the extent people are interested in where their food is manufactured, where's your electricity come from, what happens to my waste. I think there is a growing recognition that consumers have appetite for goods and services that are solving for long-term environmental or social issues. Yeah. And in the financial space, what's interesting is that as a consequence of the listing requirements on many stock exchanges around the world, you've now got this kind of orthogonal data set, which is your world of ESG, your environmental, your social, your governance information that's available. And it allows you to draw a picture between, who's carrying more risk or not around this topic, which means from a transparency perspective, it is entirely possible for that spotlight to swing onto financial products and to say, well, what's a gender diversity ratio in this fund? What's the carbon intensity of the fund relative to the benchmark? What percent of the revenue in this fund comes from companies that are involved in controversial business activities? And so
let me just make sure I understand.
Choice. Yeah.
So I understand this properly. So basically saying is that it's okay. So you got a portfolio, whatever the portfolio is. Portfolio is invested in a bunch of stocks and fixed interest indices, whatever, a whole bunch of different instruments. The reality is actually that there's data sets now that actually you can say, okay, fine. That actually tells you exactly on your point is that I'm interested in, I don't know, as you say, gender inequality as an example. Yeah. You can go and look, that portfolio can actually say, okay, fine, this is where there's investing in companies, whatever, that then can say that this is actually not a gender inequality like portfolio, but it'll have a data set on it.
Correct. And the story around responsible investing, just to sort of land it back, is it's a voluntary set of aspirational commitments. Our role organizationally is to make sure that professionally every single one of our products, given its investment process, given its philosophy and what it's trying to solve for, has got a clearly articulated way of understanding long-term systemic risk. And we integrate that into how we value companies, how we do macro thematics research, how we understand risk in a portfolio. And then it also translates into how we steward the assets. So all of that is our commitment around responsible investment. What we're also saying is that the macro thematic trend around recognition of systemic risk means that there's a whole lot of ESG data that's available. Stock exchanges are making it mandatory for that information to be published. Yeah. Investors now have access to this information. And what we're saying is that given this transition to an economy that's trying to solve towards low carbon, resource efficient, socially inclusive, one can harness these data sets to find your most efficient ride through the market. And that's kind of, if we talk about the evolution of RI or responsible investment, it's gone from this, nice to have voluntary compliance story to actually, this is the best and most efficient way to design, develop, and build products that's going to capture the best upside for clients. And it accords with, I think, the work of of the work of wealth advisors and the like, in the sense that there's a growing consumer trend toward product categories that have sustainability outcomes baked into them. And we can see that in the fund flow numbers globally.
I think obviously the key point here is you touch on the systemic risk piece.
Yeah.
So one is maybe you're not, I mean, most people are actually are conscious of being better people and better citizens in the world. But if you weren't, the reality is, from an investor point of view, actually you want a smaller systemic risk, because actually then you don't want those big potential fluctuations of volatility in what you're holding. So actually, from an investor point of view, it's actually still, no matter what, it's better to be in a portfolio that is investing responsibly.
Yeah, indeed. And so what I think is important here, and I think this is probably maybe might be helpful for the advisors, I mean, is that obviously greenwashing is an issue. You know, people say they do stuff and they're not doing stuff. You know, and that's a reality. A lot of the journey around responsible investment in South Africa has been about asset managers retrofitting the sustainability lens into their process. That's slightly different to being an investor who's designing a product from the ground up, which says this fund is going to capture the top 20% of the market from a sustainable returns perspective, and it's going to have zero producers of fossil fuels. So what I'm trying to kind of give you insight into here is that there is, you know, how you manufacture the product, so the processes you follow, how you integrate ESG, and then it's the actual contents of the fund. You know, how carbon intensive is it relative to the benchmark? What percent of the revenue in the fund comes from companies that are provide sustainable solutions? And so that's more sort of thematic in style. And so what we've seen is that there's much more regulatory oversight that's being provided around the space. So in Europe, they are getting to a point where there are now sort of fund rating categories. You know, you're either on, you know, if you want to be a fund that uses the word sustainable in your fund name, you've got to be registered under Article 9 of the STFR reporting requirements in the EU, which means that there are specific informations that you have to include in your fund mandate. That's a legal commitment. There is specific information that you need to provide on a quarterly basis to your client. And then there's certain annual disclosures you need to make. And so what I'm saying to you is that there's RI retrofit doing more of the same, just in a better way. Yeah. And then there's kind of the sort of funds that are kind of trying to capture the sustainability transition thematic. Yes. And we can talk a little bit about what that looks like for South African investors, given the shape of our economy and how you might play the green economy theme.
Yeah. I'm also right in saying is that with the different kind of, you know, your environmental sustainability, your governance piece, now almost though each of those also have different kind of trends or themes coming through. So so that's also quite. So again, you talk about the thematic plays. I suppose that's again, it's if you go in these kind of the funds that are built bottom up, they're probably in a better place to capture kind of when those different trends are coming through, or maybe that's what they're trying to do. I'm not sure.
Well, there's two things here. So the first thing is you're right. So when you look at the Johannesburg Stock Exchange, and we look at any company in any exchange around the world, from a sustainability perspective, you know, we use E, S, and G as an acronym to just simply bucket the broad category of sustainability topics: environmental, social, governance. And obviously, you know, when you are doing an ESG rating on a mining company, you compare a mining company to other mining companies. So in the mining industry, there are 4 or 5 ESG issues that matter. You know, same with, you know, in the telecommunications sector. You know, how one acquires spectrum. You know, data security, or those things are more important than, say, perhaps, you know, environmental pollution. So from an ESG perspective, there's the data and how one uses it to do a company-to-company comparisons, and how one uses that to understand sector by sector risk. Yeah. And then on the other side of the fence, there is product that's being designed from the ground up, that what is designed to capture some of the thematics. Yeah. So if you believe that, you know, the production of low carbon energy is an important thing, or highly nutritious, low calorific food is important, or organic LED manufacturers in the electronic space, or battery technology, or hydrogen manufacture. These are green economy thematics that ESG data can help you, I guess, guide you to that point in the market where the best opportunity set sits. And you can then design a thematic product, And so increasingly we are seeing in the retail space more thematic style products that are designed in this nature. And alongside of that, because of the greenwashing risk, there is increasingly legislative and regulatory requirements. So, like I said, in Europe, they have the Article 9.
Just quick one on the greenwashing risk. So make sure, I understand correctly. That's kind of when I say I'm doing something, but I'm not really doing it. So I'm ticking the box. Is that right?
Yeah, you could say, listen, we have a climate change fund, and you sell it at this climate change fund, and you use labeling with windmills everywhere. But actually, your fund is actually all it is a low carbon delta to the benchmark. So it means that your fund is 40% less carbon intensive than the benchmark, which is still a great outcome. Yeah. But the law is saying sell it as a fund that has a 40% less carbon intensive metric. Publicize that, put it in your mandate, report on it quarterly in your fund fact sheet, make that public disclosure. Don't be saying this is a 2-degree Paris aligned zero carbon climate fund.
So that's
the greenwashing,
Okay. Yeah.
Which I think is important because, for people that are advising clients around this, one has to be very clear around what you're looking at.
Cool. We've got a couple of questions coming through. I'm not going to ask them just yet, but as a reminder to the audience, please do post the questions. We always do like getting the kind of interactive conversation going. So John, just back to kind of our conversation. I mean, you mentioned SA. You mentioned Europe. Europe almost seems to be the leading kind of sector in terms of responsible investing. How is SA? Is SA lagging kind of the rest of the world? It's always because I've often felt in my experience, you chat to kind of industry players in the UK, and that they're very ESG has always been a big hot topic. Here it's always been, I say, kind of it's always been kind of a thing on the side. How's SA placed in terms of the rest of the world in terms of responsible investing or ESG?
I think South Africa, from an emerging markets perspective, has punched well above its weight relative to the emerging market peers. And I think it's been very much an institutional market story. If I had to characterize South Africa, like Europe, we've been institutionally led. It's interesting for me to see, in the US, for example, there's been a lot of pushback on responsible investing. There's been a lot of, not a lot of like a legal fiduciary pushback by trustees around responsible investing. But curiously, in the background, the US has done most of the academic research around the business case, and the retail market has exploded because people are seeing the business case. So what I'm seeing in the US is a rapidly exploding retail market that's harnessing technology and insights around the economic transition. And so that's happening. South Africa is kind of halfway between the two. We've got this big institutional machinery, and that makes sense for our big state pension funds and the like to be thinking along these lines, and Reg 28 requires it, etc. But now we're at, I think, the starting line as far as the retail market is concerned, because now suddenly you've got the innovation story starting in the local market where people are designing products that are not just a retrofit of some pre-existing product. It's actually a whole new product from the ground up that's got specific ESG characteristics baked into them, whether they are indices or actively managed funds. And at the same time, domestic investors also now globally have real live opportunity to play these thematics on the global stage, which I think is probably where the more easily accessible opportunity is for the domestic investor. And that's just a function of the structure of our economy.
Yeah. And going just back to the US quickly, sorry. Has the change in administration, Trump to Biden, does that have an impact on the kind of that institutional? So obviously Trump wasn't very keen on the environment, and Biden seems a bit keener.
Yeah, look, there's two things here. One is, I mean, you know, in my world as an environmental scientist, from an economics perspective, we also always talk about the California effect. So the California effect is like, you know, new environmental products and services kick off. Once they take hold in California, then you know they're going global.
Yeah.
You know? So it is a kind of hotbed for environmental innovation from that perspective. Systematically, if I look at what's happening around the world, is to answer your question in short, yes, the transition from a Trump to a Biden administration has, I think, hastened a trend that was happening anyway. My sense is globally is that you know, the Chinese, Mr. Xi Jinping, he's built his legacy in the Chinese kind of political environment on the back of this idea that it's not just the quantum of growth in China that's important, it's also the quality of growth. So they published their 5-year plans, and since the 12th 5-year plan, so that's now what, 15 years ago, they're out of the top 20 metrics they use to guide their growth. There's a whole growing number of them that are air quality type measures, environmental pollution measures. So we're talking about you know, so just to answer your question in a simple way, the Chinese I think have got real political intent to drive this green economic growth story.
Yeah.
I think they would have been quite happy if Trump had won, because it would have crowned Xi Jinping the global lead on this topic.
Yeah.
But Biden has come in and realized that actually this is a highly important competitive space and the race is on. And so I look out towards COP26 in November, which is now the 26th years that society has been meeting to solve for climate risk. You know, the scientific certainty around climate change, it's no longer in debate. You know, politicians realize that this is an important issue. Fiscal stimulus is being directed towards driving green growth. You know, we see the publication of green economy taxonomies. And I think Biden is seeing this happening in Europe, in China, and realizing this, America needs to step up. And if it wants to claim its space in the future, from an innovation perspective, the green economy is a space they have to compete. There's still a lot of bipartisan fighting around it in the US, but you know, from an administration perspective, certainly that shift, I think, is hastened what was happening anyway.
Yeah, so I mean, it's interesting, as you said, like it's actually is that the importance of responsible investing is actually driving policy in a way. So because they want to be, so Biden, they don't want to be lagging, they want to be up there, and they see the risk of China. So hence one of the reasons they're putting their hand up. It's not just that they believe in it. It's also
no, this is an economic. This is about economic competitiveness. I mean, the single biggest thing that is happening around the world is the decarbonization of economic growth. And the winners in the future will be those countries and those companies that can completely decarbonize their growth. And the race is on to do that. And we've seen that with net zero pledges all around the world. I mean, Europe has pledged to be net zero by 2050. South Africa's still got to publish its nationally determined contribution, which is our public commitment around decarbonizing. But if you just think about this, imagine a graph, right, that shows 2020, 2030, 2040, 2050. So you've got 3 decades, and you've got the European emissions level is here. They've got to decarbonize to net zero by 2050. Now, if you just draw a line vertically upwards from 2030, it's the first third of the triangle. It's like 55% of the emissions in the economy have to be removed. We're talking about a massive reallocation and reorientation of capital to make that happen. And that is the direction of growth in Europe. Europe is now in the process of publishing its border tariff adjustments for the carbon intensity of products that are inbound. I recently read a Morgan Stanley broker note on the extent to which South African export sectors will be impacted by the EU border tariff adjustment based on carbon intensity. So what I'm saying to you is that this is a real thing that is happening.
Yeah. So and obviously, and then hopefully the companies that are exporting in SA are then looking and saying, hang on a second, we better go our act together, otherwise we're not going to be competitive.
Correct.
We won't
So for what that means for South Africa is around decarbonizing our electricity grid, and obviously solving for Eskom is a very important thing. I mean, at a global level, we've seen this debate around, emerging market economies have to decarbonize at a slightly different trajectory to developed markets. Developed market economies are saying, listen, we will support that transition economically. South African government's in the process of discussing and looking at a potential $11 billion climate transaction to support the decarbonization of Eskom and to rapidly scale up renewables. As a country, we have top decile wind resources, top decile solar resources. We have a real opportunity to decarbonize, and I'm getting a sense that there is appetite to do that. And so the transition here will look slightly different, and hence me sort of cautioning around what the opportunity set looks like around green economic growth in the listed market in South Africa. It's probably more muted than the opportunity set that is available globally. But nevertheless, there are, in the mid and small cap space, a handful of players that are genuinely, their business model is set up around low carbon, resource efficient, socially inclusive,
Quite a few questions coming through now, which is great. So I do want to get to them. I see them popping up from Marifa on my side screen here, and they're coming through thick and fast, which is great. Cool. So, all right. So some of these might go back further into our conversation, but I think that's fine. So first one's from Brandon Naidu. Thank you, Brandon. The measuring techniques, for example, environmental scoring is so diverse. It makes it difficult to compare. Are we getting closer to solid data from trusted sources? Would you recommend any?
Look, so what's been really interesting for me, great question, by the way, and you're 100% right. If any of you are interested in academic research on this very topic, I can point you towards some stuff done by Professor Elroy Dimson. He's a Emeritus Professor of Economics at the London School of Economics. He's proper, he knows what he's doing. He did an analysis of the ESG signals across all the big ESG data providers out there. And he confirms that there is difference in the way some of the scoring is done. He points out quite accurately that the difference in the scoring is also because they are answering different questions from a sustainability perspective, and they have different weights. So the first thing I would say is that there is a lot of ESG data that is available out there, but you really have to do your due diligence around which one you choose, right? Because you are, and how you're going to use that data. As far as the measuring techniques, the things that matter from an environmental perspective, the stuff that we can bank and know that actually the numbers are good, so carbon intensity measures are good. We've got, I would say, fairly good coverage. There's global agreement. And the reality is around carbon emissions is that it's stoichiometric. If you've got calorific coal of X value going into a smelter of X efficiency, some's going into the air and the rest going into the product. It's a scientific calculation, and that's doable. Water pollution type information is fairly standardized, as is your NOx and your SOx air pollution data. But things like vulnerability to biophysical supply chain risk. It's an environmental metric. Have we got good quality data? No. So the other thing I would say on that is that both IFRS, the GRI, and a couple of the big accounting standards are now working together, because it has been a little bit of a VHS Betamax type argument around some of the stuff. And I think they've now all just got around the table and said, right, we just need to land this thing once and for all. But no easy answer there, I guess is what I'm saying.
I think also the thing we spoke about yesterday was that also you got to compare apples with apples, not fish with oranges. So depending on what, and you mentioned earlier, that different sectors have got different metrics to look at. So your mining versus your telcos, as an example. I think that's also really important.
And just to build on that, there's this issue of absolute versus relative. So a company might not have absolutely very big volumes of air emissions, but on a revenue intensity basis, it could have a highly revenue intensive business model, Whereas you might find a company that's got, on an absolute basis, quite a big volume of emissions, but that emissions only comes from a very small part of their business. And so from a revenue intensity perspective,
Yes.
they might actually not be that exposed to a carbon tax. And so the absolute volume as well as the intensity level by revenue, it's also, you have to look at it that way too.
Gee, that's, yeah, but they still might be putting a lot of carbon into the environment.
And on an absolute basis, yes.
Yeah.
But from an investment risk perspective, you would want to know how revenue intensive they were.
Yes.
So yes.
Yeah. And it's that, and that's suppose it's you got to weigh those two up. Another second question, I think it's a great question, very straightforward question, from Premanand Chetty. Are companies committed to responsible investing principles producing better returns?
I'm going to answer that question by saying no, because we don't want companies to commit to responsible investing practices. We want companies to focus their energy on shared value business models. So I can rephrase your question. Are companies who are managing their long-term environmental and social governance risk more effectively than their peers in the same sector producing better returns? I would say yes. We've compiled a lot of different ESG data into one signal ESG score that we now run across the global markets. And our view is when you quintile the performance from a top performer to a bottom performer over time, we've got like a 10-year time series now, by sector, by region, we find the top quintile from our best sustainability score that we've developed relative to the worst. There's enough of a delta to harvest that into a very effective investment strategy.
Cool.
But also to say, just because a company is doing well on these issues doesn't mean they're an automatic home run on returns. Just to flag that,
Yeah, no, fair enough. Okay, third question. Where does impact investing fit into ESG?
So ESG is an acronym that defines the broad category of sustainability issues that one looks at. ESG issues are integrated into responsible investing. Okay, so that's just a commitment around process. I think the difference with impact investing is intention. So if you go and you look up, the definitions around impact investing, every single one of them will start out by intentionality. So if your intention is to run a fund that is 40% less carbon intensive than the cap SWIX, then you have a measurable mandated metric in your fund. It's reported on. And so it's the intentionality piece. That's the first, that's the thing I would say. How that looks and feels is obviously going to be very different. Impact investing, when you look at it across a continuum, it starts all the way with grant making. So just giving away after-tax money to an NGO that you think is doing good stuff, all the way through to social impact bonds or green bonds or sustainable development bonds, through to, gender-themed impact listed equity funds. So, but what is key in that continuum is the idea of intentionality.
Okay, I hope that answers the question. Coming through quickly here. We're not going to get to all these questions, and some I'm kind of skimming over because I think you've answered them, some of them in the return question. Hope so. But I think this next one is quite a nice one. From Anonymous. How is your ESG adoption explained when within the likes of Investors Fund, its largest holdings are the likes of Sasol, BAT, and Anglos? How do you explain this to an investor? It's a really good question.
That's a great question.
Yeah.
So I think one has to, and it kind of relates to, I think, question number 5 there as well. In terms of how do we understand responsible investing? So first of all, the Old Mutual Investment Fund does not have a binary exclusionary approach to ESG issues. So we don't start with an ethical lens. We don't say we're not going to invest in X, Y, and Z. We are mandated to manage against the benchmark. And so that's an important part of the story. So we don't have any hard exclusions. from an ESG integration perspective, if you speak to Siboniso, who's the portfolio manager on that fund, what he's going to say to you is, ESG information is integrated into our investment process. We think about it at a macro thematic level. We think about it at a stock level, and we bake it into whether we go overweight or underweight on a counter. ESG issues that carry a price that we can put into the discounted cash flow forecast, we do that. ESG issues that may impact the sensitivity of the fund, or the sensitivity of the return or the margin of safety, we do that as well. And then lastly, ESG issues that we can't necessarily put a price on, we would record as a theme. The confluence of the theme and the price determines the position size. So that's the integration into the investment process. The second part of it, our commitment around responsible investing, is to steward. So regarding BAT and Sasol, I shared some material with Stephen at the start here, is that we've written up case studies on some of these counters. We engage with them extensively. We've got a 4-person team, 5-person team, whose role it is to be engaged with the companies that present real ESG risk over time. We've got a clearly documented escalation process, and we believe, being proactively engaged with these companies is important. If you think about Sasol is one of the biggest corporate taxpayers in South Africa. It employs thousands of people. It produces 25% of our liquid fuel. We're not going to not hold Sasol. Sasol is a part of our economy, but we do accept that they're a sunset industry. And the question for Sasol is, do we see them as a growth company, or is just a dividend player with a view that they're going to flatline their carbon intensity and close up shop in 2032 and return all dividends to shareholders? And that's how we think of them. It's just a pure dividend play. Or are we thinking about Sasol, and do we back the management team to do like Nokia, go from forestry to cell phones? Can the management team, and we believe being engaged with the management team and the board on this is important. And so we're interested in long-term strategy. We're interested in this transition to hydrogen. We're interested in how the executives are rewarded and remunerated. And we are hugely interested in their decarbonization strategies. So from an investors fund perspective, the quality of ESG integration and the quality of insight around those ESG risks and how we manage them, I think is exemplary. The Old Mutual Investors Fund doesn't position itself to be a fund that is 100% exposed to the green economy, because it's not, and it's simply not possible to do that in the SA market.
I think it leads us into something you and I spoke about yesterday as well. And again, so I use, for me, that the BAT is always a good one for me. So BAT, everyone goes, how can they score from an ESG perspective? Smoking's bad for your health. But the reality is that from an investment perspective, they're socially putting money back in, or whatever they're doing. They're actually doing something quite good. And it goes to the fact that actually, from a client perspective, you might have certain values that actually you don't believe in smoking, and that actually you don't want to be investing in a BAT type fund, a fund that invests in BAT. And those are two different things, being the investing responsibly versus kind of an individual value.
Yeah, the hard ethical exclusion. And there are products out there that will give you that exposure. You will be taking on benchmark risk in SA if you exclude BAT, but if you want to exclude tobacco on a global equity basis, you can actually do that with very little sort of return penalty. Just a quick point on the smoking issue. I spoke about externalities like system risks. So yes, the use of the tobacco products does cause a long-term healthcare cost that society picks up. Of course, that's why government has an excise tax. So, in South Africa, I think it's like 45 Rand, well, 45% on the face price goes to government as a excise tax. Obviously, that's the government pricing their externality costs. They don't ring fence that capital and use it only for medical care. It just goes into the fiscus. I think as a single product category, tobacco is the single biggest product category to the national fiscus from a tax revenue line perspective. So it's big money, and obviously it's at the face of a lot of controversy. However, from a responsible investor perspective, if our client says to us, don't invest in tobacco, we won't. If, however, they say, there's the universe, you go and pick the best of the worst of the bunch, then we're going to be looking across the different sectors, making sure we build a portfolio that's designed to sort of perform in the long run. And if the consumer category tobacco is in that lens, then we're going to pick the best manufacturing company in the tobacco sector relative to its peers from an ESG perspective. And if they still hold risk, we're going to be actively engaged with them on that risk. We're not going to be an absent landlord. So that's the sort of step up of professionalism that you get by RI now being in the lens for this industry. You know, the next step up is the shifting consumer behavior around ethics and sort of thematic style funds, you know, so.
And then the other thing we spoke about was our advisors' clients, and our clients are the future. So I mean, for me, that, and millennials. I mean, like, so again, and for me, it leads into that. Is again, is that so what happens at the moment? I think what we see is the client base is a lot elderly, and the wealth sits in the elderly. But the reality is that we know that'll be passed down to the next generation, and the next generation is probably kind of millennials, and they are now 40. So they're not so young anymore. And quite obviously that, I mean, even just from the questions coming through today, and these are the most questions we've had in one of these webinars, and we're not getting close to actually asking all of them, that actually this really is a really important topic. So if you're not taking, goes back to, if we're not taking this responsible investing seriously as an advisor, you're going to actually potentially lose clients. And again, I think you mentioned a stat yesterday that, was it 1 in every 3 client changes their advisor?
So the intergenerational wealth transfer risk for advisors is that I think I was reading the stats sort of from a wealth perspective, is that the rotation of advisors comes when there's intergenerational wealth transfer. And we would argue that millennials are not only digital natives, but they're also sustainability natives. And that having some literacy around this topic is probably good for your practice. We would also say that, you know, this is a permanent reorientation of capital globally around green economic growth. And we think that there is an emerging group of products out there that solve for risk, return, and impact in a very, very credible and solid way. And we think those kinds of products have definitely got a role in client portfolios. And having literacy in that space is the challenge. And obviously we look to product rating categories, we look at quality of data. We've got to arm wrestle with our clients around the difference between sort of ethical values and maximum return. So yeah,
I think it's pretty good. Again, I think one of the things we've spoken a lot about, kind of what it's about, why it's important, and the why it's important is very obvious in my mind. I'm sure everyone picks up on that. And then the next thing is again, the question. Again, it's a question we've got, but it's, and I've rephrased it slightly for anonymous. How? And it goes to the how. So how, and it's all about how, as an investor, can you participate in this in ESG, and I suppose also how can I, as an advisor, how can I understand it better?
Sure. So I can give a little bit of sort of headline thoughts here. I mean, so let's talk about green economic growth in the context of South Africa. A lot of the core themes around green economic growth are probably most easily and directly played in the unlisted space. So if you want to play renewables, for example, you kind of got to be in a private equity infrastructure type sort of bucket. So from an investment perspective, you know, you're going to get visibility to those kinds of assets through your Reg 28 compliant type products. So that's domestically in terms of pure play exposure to some of these thematics, you know, so getting maximum return for the lowest amount of risk and the best possible green economy outcomes. From a global equity exposure perspective, we would say that there's an increasingly interesting and attractive product suite out there. A lot of our innovation pathway has been, because we've been working in the institutional space where the risk tolerances are quite low, a lot of what we've been building are ESG indices. So we have got, you know, I don't know, tens of billions of institutional client capital in ESG indices. Our view is that in the passive space, there's a real role for the use of ESG data in the construction of indices. The next step in our evolution is now manufacture of higher risk, more active, high conviction products on top of that, which are capturing some of the zero carbon type thematics, both globally and locally. And so we're anticipating that you're going to see a lot more of that across the industry. I mean, I would say the domestic investor in the first instance should be making sure that the shop that is managing their funds has got the capability to understand the systemic risk and the extent to which the products they're invested in are exposed to some of those systemic risks in South Africa. At the same time, you would want to make sure that the stewardship around your client's assets is good and proper, i.e. you don't want your asset manager to be an absent landlord. You actually want them to meet the management, go to the AGM, argue with the board, and make sure that the right outcomes are driven. Then at the same time, one has to look through just the commitment to process to actually start looking at product that captures the opportunity set. And that's slightly.
I suppose it's also up to the advisors then to also ask the right questions. So you say if you're in a certain portfolio, that's what role are you playing from a stewardship point of view? How are you looking at responsible investing, and try and get a sound understanding of that.
Yeah, so we did some work about 18 months ago with some of our advisors around sort of how do you have a conversation with your client on this? And we sort of developed a little bit of a kind of decision tree and a rubric, to sort of help open the conversation. Because at the end of the day, from a wealth advisory perspective, this is about trust. And if you can align, your personal values with that of your client, and you're seeing the world in the same way, look, if you're an advisor and you believe that Trump is right and climate change is a myth and that it's a race to the bottom in terms of the best profit, well, then that's your choice. If, however, you see the world differently, well, then there's an opportunity to have that conversation with your client, and there's entry points into that conversation from a wealth advisory perspective, and it's important to be able to categorize those around, some wealth clients are like passionate, but they're misguided. And actually, all they really want to do is save rhinos, in which case, you know what? Let's do your investments normally, let's take some after-tax money and put it into an NGO around rhinos over here, and there you solve. But if someone is really interested in some of these emergent thematics, really interested in around, what the decarbonization trajectory is in South Africa and what it means for the JSE top 40, and why the asset management industry has to get behind renewables, and is interested in exposure to, companies that are going to grow because of the transition to hydrogen, then you're in a very different world of conversation with your client. I would argue that clients are getting hit with that thinking from many other different product categories in their life, from how they recycle to what electricity they consume, where they go on holiday, where they buy their clothes. So this is, we think, a permanent feature.
So there's one more question come through which I'm going to ask, and it's an OMEG question. So I think it's only fair to ask it.
Mm-hmm.
And then we can actually talk about some of your publications and the stuff you put out, which I think is really interesting and useful, and some kind of more further food for thought for the audience. So the question is from Jason, and it's, is Old Mutual going to launch a Reg 28 ESG fund? You might have one, I'm not sure.
That's a great question. So it's right in the that's the right question. It's something that we are in heavy discussion around. I mean, we've got all the building blocks. We've got the largest private. We got the largest exposure to renewable energy. We've got the biggest schools fund. We've got affordable housing fund. We've got infrastructure. So the Reg 28 compliant bucket we've got. Future Growth has been doing a bunch of great stuff in the fixed income space. We've got the offshore equity side solved, and on the domestic equity side, we've got some products, that could fit. And so we think that there's a real opportunity there. And so, if anyone has got any ideas or thoughts or wanted to exchange notes on that, I'd be very happy to engage. I mean, kind of leads us quite nicely into the publication, Stevens, from the perspective that. And I just want to kind of disclose this here, I mean, I'm sitting here talking to you as somebody who's been in this field for a decade, but I'm by no means an expert, Old Mutual and me are not going to solve climate change in South Africa. This is an industry-wide collaborative initiative, and so to the extent that there are folks out there who want more access to richer information or want to exchange notes on these kinds of things, very happy to pick up those discussions.
No, cool. I'm sure they are. I mean, so one thing maybe it's also worthwhile to mention Pat. I don't know. I mean, Pat helped a lot to the prep here. So Pat McGudler. So it also might be an idea reaching out to her. She's passionate about this stuff. So just talking about the publications. Again, this is what Pat sent us yesterday. Some of the stuff that you're putting out. So you've got. So I mean, first of all, you've just won a really nice award. So congratulations, Best ESG Responsible Investor Africa 2021. Again, it does give you the nice badge or medal around the neck. So congrats on that. And then the two reports we wanted to talk about. First of all, I think is talk about your 2020 Tomorrow publication. So again, and I mean I've got it open here for myself, but we will be sending some links to these things and put them on our website so the audience can go onto the NA Connect site and actually see where the links are and go into these publications. And then again, this as you mentioned now, this is kind of a broader report, not just about Old Mutual, but actually about you can't do this on your own. You need it's a kind of a more of an industry, external players kind of drive. Is that right?
Yeah. So the publication is called Tomorrow. It's a thought leadership piece. We get inputs from academics, NGOs. Historically, it's been quite focused on the institutional market and consultants. Last year's one, we started to sort of expand that a little bit more. This year, the two main shifts are we're focusing into the retail space as well. So, this year's theme is very much about, recognizing sort of innovations in how we govern and the sort of approach to systemic risk. And the second theme is around change. What are the things that are in the power for us to change individually in terms of our daily lifestyle choices? And so, we're getting inputs, for example, from like an NGO that specializes in food waste. All they're really doing is solving logistics for sold by food. They've got a small commercial business. It's in the hands of the consumer and the retailers to solve this. And the impact is actually quite phenomenal. And so just sort of highlighting these little toeholds in terms of how people can, participate in, I guess, what I call the fixing, So that's an open publication. Cool. And we'll be doing another one this year. And we normally have one or two webinars that are opened around it.
Yeah, and that sounds really, really cool. And the other one is the OMIG Annual Responsible Investment Report, which I think just recently come out, if I'm right.
Yeah, that's right. So that came out last month, and that's really just it's much more of a public disclosure content that describes how we tackle integration. There's some really nice summaries of our stewardship. So we steward like 380 billion of client capital in the market. We are voting at the AGMs of a hell of a lot of businesses. And, what we say matters on a rolled-up basis. We've got big positions in companies. So we are actively meeting with the boards of companies. And so this year we've done quite a nice reveal around how we are, because, we've got the biggest passive book in the country. We are the true long-term investor. Passive investors are the long-term holders of the market. And our stewardship in the passive space is the active part of passive investing. And so the publication, I think, does quite a nice showcase, which is rare. Historically, people haven't liked to talk about this stuff in public, but we've gone for it this year. So that's hot off the press, and happy to take any queries or comments around that as well.
Oh, cool. Unfortunately, we have come to the end. Our hour is up. Before I close, just to let everyone know, Bianca, how do I say, Buitendag got silver in the surfing while we were on air or we were live. So we've got 2 silvers now at the Olympics, which I think is cool. And hopefully get a few more. Just to close, first of all, to the audience for attending, really, really do appreciate your time. We know an hour is a long time out of your really busy day. So I hope you found this conversation useful. If you do have any questions, please feel free to send them through to your innate BDMs. or to your OMIG kind of BDMs. I'm sure they'll help out. And we have got, I'm sorry we didn't get all the questions. There are lots. Andrew Clayton always likes to ask questions. I didn't get to yours, Andrew. Sorry. Sean, Victor, but we have captured them, and we will pass them on to OMIG. John, really do appreciate your time. Really interesting conversation. Thank you so much. Just a reminder of the CPD process. You'll get your certificate. If you came on late, you might need to complete a short assessment, but you will get it mailed to you. And there will be a couple of links in the thank you mailer, or in some other extra info on the NA Connect landing page. Our next webinar is in August, and it's not in the room, it's actually around advice and the future of advice. So look out for the invite for that one. Otherwise, thanks all. Otherwise, that's it from us, and signing off. Cheers. Thanks, John.
Thank you.